Good morning, good afternoon, good evening, folks. Michael Zuber at One Rental at a Time, back with his good friend, Mr. Dan Bird. How you doing, sir?
Doing very well. A little cold today, though, here in Florida. We had a cold front come through.
What is cold for Florida?
So I was at a St. Patrick's Day parade yesterday, and in the morning, it was probably 88, 89 degrees, sunshine, beautiful day.
Oh, wow.
Parade started. The parade ended around 1. A big storm came in.
Okay.
And lasted for an hour, as they often do here.
Okay.
And as soon as that storm was over, it dropped to 50.
Oh, wow. That's a
40-degree drop in one day.
Wow. I don't know about you, but I don't typically dress for a 40-degree drop.
No, I know. And I kept forgetting. I kept walking my dog and I kept forgetting it was so cold.
Wow. Crazy. Well, folks, if you remember, Dan Bird and I did not connect last week. We had life events happen with myself and my experts. So sometimes we don't connect. So video number 1 is.
Yeah. Last week I went to a Peter Max exhibition. That's where I was.
I love Peter Max. I have a couple of original pieces of his and then lots of, I don't know what they are, kind of. Anyways, I love Peter Max. So I love color. So I love Peter Max. So
yeah.
Love his stuff. And little known fact, again, we've been friends a long time. You got me the autographed Peter Max book. I think it's on my bookshelf. One second. It is.
There you go.
See?
Autographed by Peter Max himself.
Yes. Somewhere in here. Anyways, yeah. Thank you for getting me this.
I have a piece of artwork that he autographed for me. There you go.
Wow. Look at that. So yeah, I love his stuff. Anyway, I digress. Why don't you do us a favor and summarize the last 2 weeks of the stock market? We haven't gotten your insights in the last 2 weeks.
All right.
Tell us what's going on.
If anybody has been following either my newsletter or my LinkedIn profile, you probably have been seeing what I've been saying for actually probably more than a month now. I'm going to share. Can you give me share capability?
I did.
Okay. All right. Can you see this?
I can.
All right. So this is the chart. This is the head and shoulders chart that I showed a while ago when this right shoulder formed up here.
I remember.
Right. And I said we were probably going somewhere in this area down here.
I remember.
Which is 3,700 to 3,800. 20% loss from the high is what defines a bear market. So that would put the S&P at 3,850.
Okay.
Which is where this blue arrow is.
Okay.
On Friday, it looked like we were going to rally, and then at the end of the day, it sold off. And most of the major stocks, most of the ones that have been propping up the market, had the same look. They all kind of sold off in the afternoon.
Yeah. Okay.
Now, part of that might just be the weekend, and with the war going on, a lot of traders don't want to hold over the weekend.
Yeah, they want to be flat for the weekend. Yeah.
Right. So they'll just exit their positions and see what happens. So it may come back and bounce on Monday, but in general, this is the pattern that we've been in since the beginning of the year. So 2.5 months now. This is January right here.
So that's about a 10% drop from peak to trough, at least currently.
Yeah, roughly. Yeah.
Roughly, yeah.
You can see, and this is a good example of technical analysis. You can see the lower highs.
Yeah.
Lower high, lower high, lower high. You can see the lower lows.
Yeah.
Lower low, lower low.
Yep.
And we probably are getting ready to make another lower low.
Yeah. I remember, again, folks, Dan has his own playlist on this channel. It comes back most Sundays. You were talking about quite a while where 4,300 was support, and now it's resistance, if I understand this.
Correct. And you can see the green arrows I have here where it acted as support. Where it kind of bounced off that 4,300 level.
Yep.
All the way back here till July, really.
Oh, wow.
And then in October, it came down and bounced, way up, made the high, came down in the end of January when the market just kind of crashed in January.
Yeah.
And bounced there. And I said then that 4,300 will probably hold at that time.
Yep.
So it bounced up, came back down, and it's just been bouncing around the 4,300, went back above it right here. But then we went below it last week, and I think that's probably going to be the last time that we see it. And this red, so I got 3 green arrows where it hit as support, and I've got a red arrow now where it hit as resistance. So typically with technical analysis, what was support will then become resistance when it goes below it, which means when it tries to come back and rally, it's going to
Right.
hit that resistance like a ceiling, if you
Yep.
will.
Yep.
And it's going to go back down. And it actually did that on Wednesday. You see this blue in here. It actually hit it almost exactly.
Yeah.
4,300.
Yeah.
I'm going to talk about credit spreads later, but I did a credit spread with a 43.10 and it hit 4,300, thankfully. So I made money on that one.
Cool.
But now it's heading down again. So Friday it went down. I think we'll go down next week. Next week is the first Fed rate hike.
Yep. Let's ask about that a little bit, because again, technical analysis works in a macro environment. Is it fair to say that you think Wall Street in the market here is set up for a 25 basis point, and anything more or less than 25 will be a shock and thus a reaction?
Yes, absolutely. It's already been telegraphed. 25 has already been telegraphed.
So if they did 0, that would be a shock, or they did 50, that would be a shock.
Yeah, 50 would be the bigger shock.
Okay.
Zero would also be a shock, and probably, even though you would think that it would be a positive, it probably will send the market lower as well.
Oh, because they think the war is bad and the Fed. Yeah. Okay. I got you.
Yeah. They think the Fed is behind the curve, which they are.
They are. No question.
Right. So if they make it 0, they're just going to be further behind. There's no way it's going to be 0.
Agreed.
So it's gonna most likely be 25. If they make it 50, that will be a shock, and the market's going down anyway. It'll just go down faster.
Yeah. I did a kind of walkthrough this morning on my daily financial news where I said the Fed's got 2 choices: 25 basis point, basically what Wall Street expects, not much of an impact on the treasuries, on mortgages. But if they did a 50, the yield curve flattens even more, but probably inverts. 30-year mortgages go up almost immediately because the market wasn't ready. And then finally, Wall Street has a fit with 50 basis, because now they think the Fed's not their friend. It's like the Fed told us this,
that's right.
Not that. Yeah,
that's right. I mean, the market is usually 6 to 9 months ahead of the economy. Anyway, and you can see the market already realized that was going to happen here in the beginning of January.
Yeah.
So the market, and when I say the market, what I really mean is big hedge funds, big mutual funds, all the big institutions that are the ones that move the market.
Right.
Okay. So they've been moving the market up all the way back here since the COVID crash.
Yep.
They've been steadily moving the market up, up until around this area, around September, October timeframe.
Okay.
And that's when they've started to get out of the market. All right. So it came down to 4,300, went back up, came down. So the institutions were selling this whole way up because they like to sell into strength.
Yep.
And then the selling accelerated, but it bounced again and went back up.
Yep.
So they sold more into strength. And now they're selling still, but they've already probably exited a lot of their big positions all the way through this period back here. So the ones that will get hurt usually are the retail traders, retail investors. Yeah. Because they don't know what these institutions are doing way back here.
Yeah, big money. Yeah.
Right. So anyway, what I did on this particular one is I added the Fibonacci levels using the low back here in last November and the high here in December.
Okay.
And you can see the pink lines here. Those are the Fibonacci levels. So 38.2 just happens to be right along this support line, resistance line. Happens to be about 40, a little above 4,200.
Okay.
And 4,200 is where we bounced here at the end of January. 4,200 is basically where we bounced right here, the end of February. 4,200 is where we are right now.
Yeah. What did we close the market at?
We closed on Friday at 4,204.
Okay. All right.
All right. I'm going to talk about that in my next section as well.
Okay.
All right. So the 50% level is 4,000 rather, right around 4,000, a little above 4,000.
Yeah. 4,024.
So we may bounce a little bit here at 4,100. There's a support level there.
Okay.
And then we probably will bounce here a little bit at 4,000.
Okay.
When it bounces, it'll probably go back up to this diagonal line.
Got it.
It's drawn right here. But I think eventually we're going down here, and you can see the 61% line for Fibonacci, this pink one right here. Look where it is.
38.50. Yep.
It is exactly at 38.50, which is the 20% decline, which defines a bear market. And markets will usually overshoot, which is why my target is in here, 37 to 38.
Okay. So what I hear you saying is very likely more pain ahead, more pain ahead, more pain ahead.
Yep, I think we'll have more pain. I think this past inflation number was expected. It might have even been a little lower than some might have expected, 7.9.
Yeah, the whisper was 8. Yeah.
Right. But I think the next one is going to be really bad.
Well, I think the next one, I've done some rough math. I think it'll be over 9.
Yeah, it very likely will, because the
Gas.
oil and gas, the gas has gone up.
And rent is starting to come through.
And rents are going up. Yeah, everything's going up. So it's going to be even worse. And so that'll be in April. That'll be March's number in April.
Yeah, CPI is going to be ugly.
And then in May, but every time we get a new inflation number, then the old really low ones drop off. We talked about that before.
Yeah, the base effect. We go back and look at some of Dan's earlier videos. We talked about the base effect. I think it's May. May
is when that last really low one drops off.
Yeah, exactly.
That's right. So May, we will start to have an inkling. No one will believe it, but there'll be an inkling that inflation is starting to slow. And then in June, it will be confirmed a little bit more. And as we go through the year, inflation, I think, will start to, the rate of change, I'll put it that way, the rate of change of inflation.
Oh, yeah, for sure.
Will start to slow.
Yeah,
inflation will still be high, but the rate of change will slow.
Yeah, because of the thing called base effect. So very cool. This is a good summary. Anything else you want to wrap up, kind of summarize what we're doing, and then we'll get into video 2 and 3?
No, but let me show my newsletter.
Yes, please. Sorry.
I don't know if you had a chance to read it.
I did. I actually reviewed it again. I read it yesterday and reviewed it again this morning.
Yeah, it's a pretty interesting one. I don't know if you had a chance to watch the videos.
I did not watch the videos. No.
They're really good.
Okay.
So I talked about credit spreads, and that's what I'm going to talk about in the next 2 sessions here today.
I just love the cartoons, as I'm sure lots of people do. Mom, are we in the stock market? No, it's all we can do to be in the supermarket. That's
right.
Very cool. Dan, thank you very much for this, folks. If you are not subscribed to this, you are missing out. breakpointtrading@gmail.com. It is free. It comes out Saturday or Sunday. Got to read it. Got to read it, at least for the cartoons, but there's always amazing value in here. Dan, thank you for all you do.
Yeah, the cartoons are at the top, so it's real easy. You just look at the cartoons and you're done.
Yeah, I won't lie. There are some weekends that's all I have time for, but I do make sure I check those out. Thanks, buddy.
Right.